What if I told you that every dollar in your 401k is about to buy 60 cents worth of actual value? That the entire American stock market is priced like we're still living in 2020, when money was free and the Federal Reserve was printing trillions to keep the economy alive? Wall Street doesn't want you to notice, but we're sitting on the most dangerous valuation bubble in 25 years. The math that justified current stock prices just broke, and almost nobody is talking about it. The stock market isn't expensive because companies are doing amazing. It's expensive because money used to be free. Here's the problem. Money isn't free anymore, but stock prices haven't figured that out yet. The S&P 500 is trading at 30.8 times earnings as of October 2025. Let me put that in perspective for you. The historical average since 1950 is 17 times earnings. We're sitting 80.9% above the modern era average, reaching valuation levels we've only seen once before, during the 1999 to 2000 tech bubble that wiped out trillions when it collapsed. But here's what should grab our attention. Those sky-high valuations only make mathematical sense when interest rates stay near zero. Today, the Federal Reserve has our benchmark rate sitting at 4.0 to 4.25%, and they're signaling it's staying there. The math that justified our current stock prices just broke. Think about this from your investment portfolio perspective. When you discount future company earnings at 1% interest rates versus 4%, those same earnings streams are worth 60 to 70% less. That's not opinion, that's basic financial mathematics. Every finance textbook teaches this principle, yet our entire $40 trillion stock market is still priced, like rates will return to zero. The relationship between interest rates and stock prices works like a seesaw. Lower rates push investors into stocks because bonds pay nothing, forcing everyone to chase returns and riskier assets. Higher rates make bonds attractive again at 4% plus returns, pulling money away from stocks towards safer investments. Since 2020, the Federal Reserve dropped rates to zero and printed $4.7 trillion, causing stocks to triple in value. It wasn't because companies got 3 times better, it was because money had nowhere else profitable to go. Here's where our situation gets dangerous. From 2022 to 2024, the Fed raised rates from 0 to 5.5%, the fastest hiking cycle in 40 years. Logically, stocks should have crashed as money flowed back to bonds paying decent returns. Instead, our market kept climbing, held up by one stubborn belief: the Fed put. Investors convinced themselves the Federal Reserve wouldn't dare let rates stay high long enough to hurt stock valuations. That belief is about to be tested, and the early evidence suggests it's false. Fed guidance through 2026 shows rates settling between 3.25 and 3.50%, not dropping back toward zero. They've learned the hard lesson that zero rates create dangerous asset bubbles and inflation problems. The era of emergency monetary policy as normal policy is ending. Let's examine what this means for the companies driving our market higher. The Magnificent Seven tech stocks are trading at 50 to 80 times earnings, nearly double the already stretched market average of 30 times. These companies, Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia, represent nearly 30% of total market value. Their valuations assume not just zero interest rates, but negative real rates after inflation. Pop quiz: what happens to a stock trading at 60 times earnings when investors can suddenly earn 4% risk-free in Treasury bonds? The math becomes brutal. That company needs to grow earnings 15% annually for 4 straight years, just to justify today's price, assuming rates stay at 4%. Miss those growth targets, and the stock price collapses to restore mathematical balance. Our entire stock market ecosystem built itself around an assumption that proved temporary. Pension funds, 401k plans, university endowments, and sovereign wealth funds all structured their portfolios expecting continued low rates. According to the Federal Reserve's own data, 60% of American household wealth sits in stock market investments through retirement accounts. These aren't sophisticated hedge fund managers who can quickly adapt. These are regular Americans whose financial futures depend on index funds that automatically buy the most overvalued mega-cap stocks. The valuation disconnect runs deeper than individual stocks. Corporate America borrowed massive amounts at near zero rates to fund share buyback programs, artificially inflating stock prices by reducing share counts. When rates were 1%, borrowing money to buy back stock at any price seemed genius. At 4% borrowing costs, those same buyback programs destroy shareholder value. According to Securities and Exchange Commission filings, S&P 500 companies spent over $1 trillion on buybacks from 2020 to 2024, much of it funded with cheap debt that now carries expensive refinancing costs. Think about your own financial decisions during the zero-rate era. Maybe you stretched to buy a more expensive house because mortgage rates were 2.5%. Perhaps you took investment risks you normally wouldn't because savings accounts paid nothing. Corporate executives made similar calculations, except they were playing with shareholder money and stock-based compensation that made them wealthy when prices rose. Now those decisions face the reckoning of higher rates. The wealth effect that drove consumer spending for 4 years is reversing. When your 401k and brokerage accounts were climbing 20% annually, spending an extra $2,000 on vacation felt reasonable. When those same accounts start declining, that spending disappears quickly. Consumer spending represents 70% of our economic activity, making this wealth effect reversal a significant economic headwind that further pressures corporate earnings. International money flows compound our domestic valuation problem. Foreign investors poured money into U.S. stocks during the zero-rate period because European and Japanese rates were actually negative. Now, those same international investors can earn attractive returns in their home markets without currency risk. The Bank for International Settlements reports that cross-border equity flows into the United States have already begun declining as global rate differentials narrow. What makes this valuation trap particularly insidious is its self-reinforcing nature. As long as stock prices kept rising, the high valuations seemed justified by momentum. Portfolio managers who questioned the math got fired for underperforming benchmarks. Financial media celebrated new market highs without examining the underlying assumptions. Even sophisticated institutional investors convinced themselves that this time is different because technology productivity gains would justify any price. The mathematical reality can't be ignored indefinitely. When the Federal Reserve signals that rates will stay elevated and inflation pressures prevent aggressive cutting, the discount rate used for valuing future earnings permanently shifts higher. Every financial model, from simple dividend discount calculations to complex option pricing formulas, produces lower fair values for stocks when rates rise from 1% to 4%. The repricing isn't gradual, it accelerates once momentum shifts. Our stock market built a valuation structure that requires zero interest rates to make mathematical sense. The Federal Reserve has moved those rates to 4% and signaled they're staying there. The foundation supporting current stock prices just shifted, and the building is starting to lean. When gravity finally takes over, the collapse won't be gradual. Everything built on the assumption of permanent zero rates gets repriced simultaneously, and the math is unforgiving. The question isn't whether this valuation correction happens. Basic financial mathematics guarantees it will. The question is when market participants finally accept that interest rates aren't going back to zero, and what that recognition does to $40 trillion worth of overvalued assets. The answer is starting to emerge, and it's not pretty for anyone whose wealth depends on the stock market maintaining prices that only made sense when money was free. Everyone's betting the Federal Reserve will slash rates back to zero when the stock market starts falling. That's exactly what happened in 2008, and investors made fortunes buying the dip. But here's what Wall Street doesn't want you to realize. The playbook that saved markets 17 years ago won't work this time. The Fed officials are trapped in a corner they've never faced before, and the escape routes they used during previous crises have been permanently sealed off. Back in 2008, our central bank had room to maneuver. When Lehman Brothers collapsed and markets cratered, the Federal Reserve dropped rates from 5.25% to zero without breaking a sweat. Why did that rescue work so smoothly? Our national debt sat at $10 trillion. Inflation was actually falling, and the dollar remained the unquestioned global reserve currency. Cutting rates cost the Treasury relatively little, helped banks immediately, and didn't threaten our currency's stability. Fast forward to today, and every single one of those conditions has reversed. Our national debt exploded to $36 trillion, meaning each 1% rate cut now costs taxpayers $360 billion annually in lost interest savings. That's not stimulus money. That's a permanent budget hole that makes our deficit crisis worse every year rates stay low. Think about the political nightmare this creates. When rates drop, the government saves money on interest payments, but only temporarily. Those savings get overwhelmed by the economic damage caused by asset bubbles and inflation. Politicians learned this lesson the hard way when zero rates from 2020 to 2022 triggered the worst inflation surge in 40 years. Voters remember grocery prices doubling and gas hitting $5 per gallon. No administration wants to own that disaster again. The inflation situation makes aggressive rate cutting impossible. PCE inflation hit 9.1% in 2023, the highest reading in 4 decades, and it's still running above the Fed's 2% target. Labor markets remain tight with unemployment at 4.2%, below what economists consider the natural rate. Wage growth continues pressuring service sector prices, the stickiest component of inflation. Here's what makes our current trap different from 2008. Back then, cutting rates to zero helped because deflation was the bigger threat. Now, inflation expectations remain elevated despite 2 years of Fed rate hikes. According to University of Michigan consumer sentiment surveys, Americans expect inflation to average 3.2% annually over the next decade, well above the Fed's target. Cut rates aggressively, and those expectations become self-fulfilling prophecies as borrowing costs drop and spending accelerates. The Federal Reserve already experimented with dovish signals in September 2024, cutting rates by 50 basis points and surprising markets with guidance suggesting more cuts were coming. What happened next? Inflation measures immediately ticked higher, forcing Fed officials to walk back their dovish stance within weeks. That failed experiment taught them that markets are hypersensitive to any hint of returning to emergency monetary policy. Current Fed projections show rates settling between 3.25 and 3.50% by the end of 2026, not the 0 to 1% levels that justified current stock valuations. These aren't arbitrary numbers. They reflect structural changes in our economy that make lower rates dangerous. Massive government debt loads, deglobalization trends, and productivity growth concerns all push the neutral interest rate higher than the pre-2008 era. But here's where the Fed's credibility problem becomes critical. For 15 years, central bankers convinced markets they would always step in to prevent major stock declines. The Fed put became an article of faith among investors, encouraging increasingly risky behavior because everyone believed the central bank wouldn't let asset prices fall significantly. That implicit guarantee worked when rates could drop from 5% to 0, providing massive stimulus firepower. Now, our central bank faces a credibility crisis. If they cut rates aggressively to save stock markets, inflation surges and their primary mandate gets destroyed. If they hold rates steady while markets correct, the Fed put narrative collapses, and leverage investors face massive losses. Either choice damages Fed credibility, but inflation is the more immediate political threat. International pressure compounds the Fed's domestic constraints. The dollar's reserve currency status depends on maintaining higher yields than other major economies. European central bank rates sit near zero, and the Bank of Japan maintains negative rates through yield curve control. If our Fed cuts to match those levels, international investors dump dollars for currencies offering better returns, triggering imported inflation through a weaker exchange rate. The debt sustainability math makes extended low rates impossible. According to Congressional Budget Office projections, our debt-to-GDP ratio reaches 115% by 2034 under current policies. That assumes interest rates averaging 3.5%, drop rates to 1%, and the resulting economic stimulus increases spending while reducing government interest income, making the debt trajectory exponentially worse. Bond markets would eventually rebel, forcing rates higher, regardless of Fed policy. Corporate America's debt structure creates additional pressure against rate cuts. S&P 500 companies borrowed heavily during the zero-rate era, often to fund share buybacks rather than productive investments. Total corporate debt doubled from 2008 to 2024, reaching levels that require refinancing over the next 3 years. Keep rates low, and these companies continue zombie-like existence without improving productivity. Raise rates, and weak companies fail, while strong ones adapt, painful but necessary for long-term economic health. The wealth inequality problem that low rates created now prevents their return. 0% interest rates inflated asset prices, primarily benefiting the wealthy who own most stocks and real estate. Working Americans saw their purchasing power eroded by inflation, while asset owners got richer from Fed policy. Political pressure now favors normal interest rates that provide income to savers rather than speculation's rewards to investors. Financial stability concerns give Fed officials another reason to avoid aggressive cutting. Ultra-low rates encourage dangerous risk-taking throughout the financial system. Banks loaded up on long-term bonds that lost value when rates rose. Private equity firms borrowed massive amounts for leveraged buyouts. Pension funds chased yield in increasingly exotic investments. Returning to zero rates would restart these dangerous dynamics, setting up an even larger crisis down the road. The Fed's own research shows that rapid rate cuts create more problems than they solve when debt levels are high and inflation expectations remain elevated. Academic studies of previous hiking cycles demonstrate that premature policy reversals often require more aggressive tightening later, creating larger economic disruptions. Fed officials learned these lessons and won't repeat the mistakes of the 2010s when they raised rates too slowly and cut too quickly. Market expectations remain dangerously disconnected from Fed capabilities. Options markets and Treasury futures are pricing in rate cuts that bring the Fed funds rate below 2.5% by mid-2026. Fed officials' own projections show rates staying above 3.25% through that period. This disconnect sets up massive repricing when markets realize the cavalry isn't coming to rescue overvalued assets. The political calendar makes aggressive rate cutting even more unlikely. Midterm elections in 2026 mean politicians will focus on inflation and cost of living issues rather than stock market performance. Voters care more about gasoline and grocery prices than their 401k balances, especially after experiencing the inflation surge of 2021 to 2023. Any Fed policy that risks reigniting inflation becomes politically toxic. Fed officials are trapped between inflating the asset bubble or letting valuations correct to sustainable levels. They chose bubble inflation for 15 years, always finding excuses to keep rates artificially low. In 2026, they're finally losing control of that choice. The economic and political costs of ultra-low rates now exceed the benefits, even if stock markets suffer as a result. The era of central bank market support is ending, whether investors accept that reality or not. The reckoning is coming, and the math is brutal. When 30 times earnings corrects to 17 times earnings at 4% interest rates, $40 trillion in stock market value doesn't just disappear gradually. It vanishes in months, taking retirement dreams and financial security with it. Let me walk you through exactly how this unfolds, because the timeline is closer than most people realize. The best-case scenario assumes our economy achieves the mythical soft landing that every Fed official promises, but history rarely delivers. Rates stay between 3.25 and 3.50%, corporate earnings grow 5% annually, and inflation remains under control. Sounds reasonable, right? Even in this optimistic scenario, the S&P 500 needs to correct 27% from current levels just to reach fair value. Why 27%? Because when investors can earn 3.5% risk-free in Treasury bonds, paying 30 times earnings for stocks becomes mathematically indefensible. Fair value drops to 22 times earnings, and that's assuming companies keep growing profits at above-average rates. Miss those growth targets by even small amounts, and the correction deepens quickly. But soft landings are rare when the Fed maintains restrictive monetary policy for extended periods. History suggests a more realistic scenario involves mild recession, as higher rates eventually bite into economic activity. Corporate earnings typically fall 10% during recessions, while P/E ratios compress toward 18 times earnings as investors demand higher returns for increased risk. Do the math on that scenario. Earnings down 10%, fair P/E ratio at 18 times instead of 30 times. The S&P 500 falls 40% from current levels, wiping out $16 trillion in market value. That's not market crash territory. That's normal cyclical correction territory when valuations start this stretched. The nightmare scenario involves inflation resurging, forcing the Federal Reserve to raise rates back toward 5% while corporate profits decline. We've seen this movie before during the 1970s stagflation period. PE ratios compressed to 15 times earnings or lower, while corporate margins shrunk under pressure from rising input costs and weakening demand. In that environment, stock markets can fall 50 to 60% and stay down for years. But here's what makes 2026 specifically dangerous. The Fed will likely cut rates during 2025, creating false hope that supports stock prices temporarily. Markets always rally when rate-cutting cycles begin, regardless of underlying economic fundamentals. This rally convinces investors that the old playbook still works and the Fed put remains intact. Then reality hits between the fourth quarter of 2025 and first quarter of 2026. Fed officials slow or stop rate cuts as inflation pressures resurface. Labor markets remain tight, wage growth stays elevated, and service sector prices continue climbing. The central bank realizes they cut too much too quickly, just like they did in the 1970s. By mid-2026, financial markets finally accept that rate cuts are over, and rates are staying above 3% permanently. That's when the multiple compression accelerates. Stocks trading at 30 times earnings get repriced to 20 times, 18 times, and eventually 15 times as investors demand returns that reflect the new interest rate reality. The speed of this repricing shocks everyone who remembers gradual corrections from previous decades. Today's market ecosystem amplifies volatility through multiple feedback loops that didn't exist in the 1980s or 1990s. Algorithmic trading executes sell orders faster than human judgment can intervene. Exchange-traded funds force automatic selling when redemptions exceed cash levels. Options market makers hedge their exposure by selling stocks when volatility spikes. Leverage throughout the system transforms a 30% fundamental correction into a 50% market decline. Margin debt reached record levels during the zero-rate era as investors borrowed against stock positions to buy more stocks. When prices fall 20%, margin calls force automatic selling, regardless of long-term value. Private equity funds and hedge funds borrowed heavily to amplify returns, creating additional forced selling pressure when prime brokers demand collateral. The 401k catastrophe unfolds in waves rather than all at once. 60% of American household wealth sits in retirement accounts that automatically purchase the most overvalued mega-cap stocks through index funds. These funds don't make valuation decisions. They buy whatever stocks have the largest market capitalizations, regardless of price. When mega-cap technology stocks begin declining, index funds experience massive redemptions as panicked investors try to preserve retirement savings. Fund managers must sell their largest holdings to raise cash, creating a vicious cycle where the biggest stocks fall the most. The concentration risk that made these funds heroes during the bull market becomes their nightmare during the correction. No central bank rescue materializes because the Fed lacks both the ammunition and political support for aggressive intervention. Interest rates at 4% provide limited cutting power compared to 5% rates during previous crises. More importantly, inflation concerns and debt sustainability issues prevent the massive monetary stimulus that characterized 2008 and 2020 responses. Politicians face a terrible choice between saving stock markets and controlling inflation. After experiencing the political damage from 40-year high inflation rates, no administration wants to repeat that mistake. Voters remember grocery stores and gas stations, not brokerage account statements. The political calculus favors fighting inflation over supporting asset prices, leaving stock investors without their traditional government backstop. International capital flows accelerate the domestic correction. Foreign investors who poured money into overvalued U.S. stocks during the zero-rate era can now earn attractive returns in their home markets without currency risk. European bonds, Japanese government securities, and emerging market debt all offer competitive yields compared to dividend yields on expensive American stocks. Capital flows reverse, adding selling pressure to domestic institutional redemptions. The correction feeds on itself through wealth effect destruction. Consumer spending represents 70% of our economic activity, and much of that spending was financed by stock market wealth gains. When 401k balances fall 30 to 50%, households immediately reduce discretionary expenditures. Vacation bookings plummet, restaurant visits decline, and retail sales crater. This spending reduction pressures corporate earnings, justifying even lower stock valuations. Corporate buyback programs that artificially inflated stock prices during the boom become value destroyers during the bust. Companies borrowed heavily at low rates to repurchase shares at inflated prices. Now they face refinancing that debt at higher rates while their stock prices fall below the buyback cost basis. Share count reductions that boosted earnings per share numbers reverse as companies issue stock to raise cash for debt service. What finally stops the decline? Basic mathematics provides the answer. Stock prices won't stabilize until PE ratios reach 16 to 18 times earnings, the historical range that reflects 4% interest rates. Achieving that fair value requires either massive earnings growth that seems unlikely during a correction, or further price declines that bring valuations back to sustainable levels. The recovery timeline stretches longer than most investors expect. Previous bear markets ended when the Fed cut rates aggressively, providing immediate stimulus that justified higher valuations. In 2026 and beyond, structural factors keep rates elevated even after the correction completes. Debt sustainability concerns, inflation anchoring, and productivity challenges maintain a higher neutral rate environment. Capital deployed at current valuation levels buys essentially nothing for a decade. Investors purchasing stocks at 30 times earnings during 2025 won't see positive returns until either earnings triple or interest rates return to zero. Neither scenario seems likely given fiscal constraints and inflation history. The opportunity cost of missing 10-year Treasury bonds yielding 4% becomes painfully obvious in hindsight. The generational wealth transfer accelerates as older Americans sell overvalued assets while younger generations wait for reasonable entry points. Baby boomers who need to fund retirement can't afford to hold stocks through a multi-year bear market. Millennials and Gen Z workers recognize that paying 30 times earnings makes no mathematical sense when bonds yield 4%. Age demographics compound the selling pressure from institutional factors. Interest rates at 4% aren't temporary. They represent the new structural floor for a debt-burdened economy facing persistent inflation pressures. Stock valuations priced for 1%, rates must be repriced for this new reality. The gap closes through falling stock prices, not falling interest rates. When $10 trillion in retirement savings realizes the Fed put is gone, the repricing accelerates to completion. Markets find fair value again only after destroying enough capital that interest rates matter less than survival. The correction won't be gradual, and the recovery won't be quick. The mathematical reckoning that should have happened in 2022 was delayed by false hopes and Fed put beliefs. In 2026, gravity finally wins, and $40 trillion in overvalued assets discovers what 4% interest rates really mean for stock prices that made sense only when money was free.